Hello, I'm Jerry Slusewitz. Welcome to one of my Your Money Talks videos. This is a series that I put out as I see changes in the market or things that cause me concern. Today's Thursday, May 15th, middle of May. It's been a little bit of time since we put one of these things out. We were concerned last time about a head fake. Was the market truly breaking out or was it truly going down? And it hasn't really resolved itself. The Dow Jones Industrial Average did go to an all-time closing high, as well as the S&P 500 in the last week. But those are the big, capitalized, large U.S. companies. Those large companies are moving higher. Is it because of new breakout, or is it because investors, mostly the institutional advisors, are getting out of the NASDAQ, getting out of the small cap index, the Russell 2000, that are less liquid and moving into the most liquid names in the business? The big blue chips, and the Dow is made up of 30 companies. The S&P 500, well, it's 500, is really skewed to the top 50 or 100 companies in that 500 list. So we're still seeing this divergence. That's one of the biggest concerns I have. Is the previous leaders, the NASDAQ or Russell 2000, are down almost 10%. The Russell 2000 is breaking down here today. The Dow's down 200 points as I tape this. It was down 100 points yesterday. So are the previous leaders dragging the big sector down? Well, was that going to be the outcome? Or will it hold itself and resolve itself with just new leadership being big cap stocks? Yet to be seen. One of the biggest concerns that I have right now is the 10-year Treasury. 10-year Treasury is trading below 2.5%. The Treasury market's much, much, much bigger than the stock market. And that Treasury market is something to keep our eye on. Lower interest rates, which is what we're seeing now. We're at 3.05 on the 10-year Treasury coming into this year. Now we're back below 2.5. That is very concerning. It is deflationary in nature. We had a 0.1% GDP report, and people are saying, yeah, we're going to get better growth. We don't see it. Walmart reported earnings today. They said, oh, we had a bad first quarter. We missed earnings. And it was because of the weather. And that'd be good if you didn't know that Walmart missed 4 of the last 5 quarters on their earnings estimates. They had nothing to do with the weather, because out of the past year and a quarter, some of those months had some pretty doggone good weather. So they're trying to pull the wool over our eyes. It's important to have a plan for protection in this environment. We are still participating. We've actually added positions on the big cap stocks. We've eliminated some of the exposure to the smaller, more NASDAQ type names. And it's very, very important to protect yourself in this environment. This divergence is real. It's yet to resolve itself. We are in the seasonally more difficult periods. Generally, the sell in May and go away comes into play, and people have seen over the last 100 years returns from the May through October period that have been subpar to the November through April period. But last year, 2013, that May through October period did pretty good. So it doesn't mean just go and sell everything, but it's important to observe because we have this divergence going on, and like today anyways, we're seeing big cap stocks being dragged down. It's time will tell, but the biggest canary in the coal mine to me is that 10-year Treasury. What's going on with interest rates? Is the economy truly slowing down? The 10-year says it is. Be careful out there. Call my office, 1-800-449-9501. Follow me on Twitter at PFPinvest. And again, thanks for tuning in to another edition of Your Money Talks.